The price of Bitcoin has fallen 10% in the past 7 days, seeing its worst weekly performance so far this year. Nevertheless, it's still up 60% year to date. For a look at the moves we've seen in crypto, Michael Rapkin is the global head of business development at DV Chain, and he joins us now. Michael, I guess I should say happy Infinity Day first, which is, it's just the date, right? 8 Infinity over 21 million Bitcoin. Is that what it is?
Exactly. So happy Infinity Day. And I want to apologize for my voice. I'm a bit under the weather today. So thanks for having me on, Amber.
Okay, well, thanks for making it, even though you are under the weather. We've seen Bitcoin sell off in sort of a risk off move. You know, I always struggle to explain why did it go down as much as I struggle to explain why did it go up. But as somebody who's in the space, there were a few catalysts. Walk us through what you see as the pressure that we're seeing.
Yeah, so as you mentioned, the last 7 days have been the worst week in 2023 for crypto. Nevertheless, Bitcoin is still up almost 60% year to date, and ETH is up almost 40% year to date. So, what we saw last week, Amber, we saw more sellers than buyers in the market, which put pressure on the price. Bitcoin has also more recently become more susceptible to wilder price swings, and as trading volumes on exchanges have declined, essentially large trades are able to have a greater impact. We've also seen fairly low volatility over the summer. And with some news flowing through the mill last week, we think it triggered a lot of liquidations because, vol was low and stops were tight. Additionally, Bitcoin is a risk-on asset, in our opinion. And with issues in the greater economy, like concerns over issues with China's property, market leading to possibly a wider economic downturn, it could put additional pressure on Bitcoin. And then lastly, one of the things that put additional price pressure on Bitcoin was the anticipation of spot Bitcoin ETF approval. And so with the SEC declining that last week, I think a lot of members in the market were kind of, disarrayed and sentiment came off. That wasn't a surprise to us. The approval, we think, will still continue to happen. It's just becoming delayed.
I guess that's kind of where the future of Bitcoin does lie, is the rate of institutional adoption, the extent to which that got spooked off after the collapse of FTX. You're somebody who spends time in this space, speaking to those institutions, trying to draw them to the crypto universe. How has that evolved since FTX?
Yeah, so, obviously when FTX happened, as you mentioned, a lot of people were spooked, a lot of institutions were spooked, and they kind of, backed away a little bit with wanting to bring a product to market, with wanting to understand. But, we're almost, it's crazy to say, but we're pretty much 2.5 months away from a year since that happened. It's kind of in the back burner where people are kind of looking forward to how they can, better utilize blockchain or Bitcoin or other cryptocurrencies into their business. We are seeing a renewed interest from institutions, and we've seen it with BlackRock. BlackRock, I think it was about 2 months ago, came out and announced an approval, or they want to get approved for a spot Bitcoin ETF. And, they have a pretty high approval rate with regards to that. I think they've only had one rejection out of about 567, something like that, and don't quote me on that. But we have seen a renewed interest across the board, whether it's, BlackRock or whether it's other banks that are looking to get into the space.
Can Bitcoin gain sustainable momentum, become anything than sort of a niche instrument in finance if the U.S. does not adopt crypto with more open arms?
So, with regards to regulation, I always like to say, Amber, regulation is not unattractive, uncertainty is. And we have seen that come from the US, right? We have seen them, different regulatory bodies go after, different companies for different reasons. From a Canadian perspective, we think regulators here have been doing a much better job in getting feedback from the industry and building an ecosystem for other companies, international companies, global companies, to come into Canada and help build out their business. So to answer your question, in short, I think if the U.S. doesn't, adopt regulation, yeah, it's going to create a hurdle. It might create some, sentiment that's slowed down, but it's not going to end crypto. And there's definitely, jurisdictions out there that are willing to open up to crypto companies with open arms that already have an infrastructure in place on how to do that.
And you mentioned Canada. Last week, I interviewed the CEO of Coinbase, Brian Armstrong, on their expansion in Canada and asked kind of that question: does Canada have the ability to punch above its weight when it comes to cryptocurrencies? How do you see that?
Yeah, for sure. And, I 100% agree with that comment. As a country in general, we are getting a growing reputation as a blockchain-friendly jurisdiction. As I mentioned, a moment ago, regulators have been consistently engaging with us and other industry participants, including retail participants, with how, crypto, how blockchain, how they see it affecting their lives. And, with us being able to actually build out an infrastructure that says, hey, this is what you can offer as a company, this is how you will be regulated, it creates a much better infrastructure and a much more attractive infrastructure for companies to come into Canada and build out their companies here, rather than going through the US, where things are still a little bit unclear.
Michael, we got to leave it there. Thanks so much for joining us with this perspective. I hope you feel better. That's Michael Rabkin joining us from DV Chain.
All right, let's get back to Shopify. It has another bull on the block. An analyst at Wedbush launched coverage of the stock with a buy rating, and he's forecasting a relatively tame 15% return over the next year. Our Paige Ellis dug into the report, and she joins us now with more. So break down this call for us from Dan Ives here.
Right, a notable call by Dan Ives. Shopify has been a really interesting story over the past few years. It rode the pandemic wave to an all-time high back in November of 2021. Then, of course, it came back down to earth. This year, it's worked to turn around its business, and that's what really forms the basis of this bull case, according to Dan Ives. So, as we know, Shopify has been trying to cut costs. They've been reducing their headcount by a few thousand people. They've also introduced recently this strategic change. So back in May, you'll recall, Shopify announced that it was selling its logistics business to Flexport, which essentially amounted to it abandoning its fulfillment strategy, which it had been, embarking on for a few years. It had invested many, many millions, in fact, a little over $1 billion. Wedbush sees a lot of potential now that it has sort of refocused on its core competencies. Wedbush says that the company now has sort of the appropriate scale and competitive position to really see a lot of lift. That business that it had, of course, the fulfillment strategy, it says, has a lower margin than its core underlying business, which is just selling e-commerce software. It also says that once a company like Shopify brings a smaller, medium-sized business into its ecosystem, it's really effective at upselling those merchants. So it sees a lot of boost there. Also, Wedbush talks about the payments penetration. So payments, it says, are poised to rise. Right now, Shopify is on pace to process over $130 billion worth of payments, gross payments volume this year alone. That's a 25% year-over-year increase. It thinks there's much more runway there. And the final piece is the international expansion. Shopify has been making a big push outside of North America, and international revenue accounts for about 34% of Shopify's total sales. And it says, based on how it's doing, the penetration that it's seen in markets like Germany, France, Spain, and Italy, it sees a lot more upside there.
Okay, so yeah, some reasons for optimism there for Shopify. However, not everyone's bullish on the company. In fact, that well-known, though controversial investor, Cathie Woods, her firm recently sold a big position.
Absolutely. So yes, Kathy Wood's ARK Investment Management. She's best known for that, of course. We learned just recently that the ETFs managed by ARK sold over 130,000 shares of Shopify recently. So they released some trade figures that gave us those details. That amounts to a little over $9 million worth of Shopify shares. No indication why. Haven't yet heard back from them. I will say, though, that overall the street is quite bullish on Shopify. 21 buy ratings, 26 holds, only 3 sell ratings on the street. And interestingly, Wedbush, which is ascribed a $62 price target for Shopify, the NYSE listed stocks, that's only 15% upside. But broadly, the Wall Street does see quite a bit more upside than that. So overall, it seems Wall Street and Bay Street are pretty bullish on this. But there is some interesting indications from ARK, at the very least, that they sold.
Yeah, interesting. Well, it'll be interesting to continue to watch Dan Ives' coverage on this as well. He always has pretty colorful language for whatever company he's
Though
watching
not
that
in this
particular
case,
day.
Jacqueline. This was a bit of a muted report. Amber Canmar and I were talking about how uncharacteristically uncolorful the report was, but there we go.
Well, maybe he's just getting started. Or maybe he's trying to be polite for the Canadians. Who knows? Paige, thanks so much for this. That's BNN Bloomberg's Paige Ellis.
So we are getting retail numbers for Canada. It looks like June in line with consensus, but July pointing to an increase of 0.4%. So a sign of strength there for the Canadian consumer. Let's digest those numbers and lots of other ones with Carl Shimotta, Chief Market Strategist at Corpay. It's great to see you.
You as well.
Just give us your take on Canadian retail sales. Has the Canadian consumer gone into retreat?
Not yet. It does look like consumers, households in general, are sort of running on fumes at this point. We know that, disposable income gains have slowed pretty dramatically, that they're cutting into savings, but they're still spending quite a bit of money. The one thing here that's sort of worrisome in the June report is that we did see an ex-auto decline. So, households spending outside of spending on autos declined quite sharply, while at the same time, the July preliminary estimate is pointing to continued robustness and, in fact, a rebound in spending. So that's I think the first big rebound in 4 months in Canadian retail spending. And all of that, suggests that the Bank of Canada's job in bringing down excess demand in the Canadian economy is not yet mission accomplished. I certainly wouldn't suggest that we're looking at a rate hike anytime soon, but at the same time, this is a sign that just like the Fed, the Bank of Canada is going to have to remain alert for a rebound in that consumer spending side of the economy.
You don't think that we're looking at another imminent rate rise from the Bank of Canada?
No, I think when we look at the softness that we're seeing elsewhere, so in employment overall, when we look at sort of the below the hood details in the economy, I think there's a lot of reason for caution there. And the Bank of Canada is going to, sort of weigh that side of it more heavily than they're looking at the inflation side. All that said, they're going to remain relatively hawkish in terms of the rhetoric. I don't expect them to, sort of have that big moment where they come out and say that inflation has been vanquished and that they no longer have anything to worry about. They're going to maintain that sort of telegraphing to markets that another rate hike is possible in the autumn months.
What about the United States? Actually, explain this to me as a long-term observer of interest rates. The American 30-year mortgage rate now reportedly around 7.5%.
Right.
I mean, that's a long time to be borrowing money at that rate.
Yes.
Why are interest rates going up so much?
Right. So I think there has been a capitulation, right? I think markets in general have suddenly realized, that the inflation pressures in the economy are actually stronger than they were prior to the pandemic. They're also looking at a flood of issuance from the U.S. as well as virtually every other sovereign, in the world.
Bonds, just printing up bonds.
Exactly. Lots and lots of printing. And so what's sort of interesting in the last couple of weeks is that it might be somewhat technical in nature, right? We might have had a situation where all of this supply was coming into markets that were relatively thin, and that pushed, yields up a bit. All that said, the fascinating thing when you look at the U.S. right now is that firstly, of course, prices have not really moved. In fact, they're still marching up across the U.S. Home prices are still marching up. And if you look at that sort of big peak in rates that we're seeing, it is not that high in real terms. We've just recently popped back into positive territory in real terms. And so, the key here is that, for most of this year, homeowners have been borrowing, taking out a mortgage against an asset that is appreciating, and they're paying less than the rate of inflation. So when you take all of that together, it was a big tailwind for the housing market, even as, I think most of us were looking at that nominal rate and expecting a shift in behavior among home buyers.
But explain that to me. I mean, if the mortgage rate has gone 30-year, gone north of 7% in America, I mean, inflation is nothing like 7%.
No, not anymore. It has moved up, on a sustained basis in the last couple of weeks. But when you look at where break-evens are relative to the interest rate itself, then you're looking at, just narrowly moving into real territory. And so, I think the key here is that when you're looking at an economy that is generating that inflation for virtually everything else, it makes sense to buy an asset that will appreciate with it, right? And so I'm not saying that there wasn't a headwind for buyers. There certainly was, and we've seen a huge decline in the number of listings coming out. We've seen a big decline in the number of buyers coming in to purchase homes, but prices have remained relatively stable. And so, it's
sorry, Carl, you're talking about U.S. and Canada? Or
the U.S. and Canada, actually,
okay,
yeah.
Sorry.
I was talking really specifically about the U.S., but the funny thing is we have very much seen the same dynamic here in Canada, right? It's probably something that no one had on their bingo card at the beginning of the year, right? This idea that high interest rates might actually keep prices elevated because no one wants to list their home and no one wants to move to a new mortgage.
That's interesting. So stickiness in that asset class. People don't want to renew a mortgage at high rates.
They wouldn't. It makes sense to hold on where you are. I think this is terrible for the economy in the short run, especially because that means we have lower labor mobility, right? Like if you're not going to move to take a new job, if we're going to all stay put in our homes and sort of maintain the mortgage rates that we have, that's bad for the economy. But in the short run, the fascinating thing is that we have seen that sort of, that demand and supply imbalance actually widen in a way that I don't think anyone actually predicted, January of this year. I think virtually everyone, myself included, got it wrong. We all thought
on home prices.
Yes, we all thought that this higher borrowing cost would slow the pace of activity, drive prices down, and that would impact overall consumption in the Canadian economy. And that just has not transpired. Maybe it'll come soon, but it has not happened yet.
Jay Powell expected to speak Friday morning.
Yes.
And what signals should investors look for?
Well, that's a fascinating thing here, too, because this is sort of like Donald Rumsfeld saying that, that there are known unknowns. The reality here is very few market participants are taking a big position going into this, right? We just don't know what he's going to say. He could remain largely theoretical. He could follow Yellen and some of his predecessors in talking about the neutral rate of interest and focusing specifically on structural changes in the economy, which is what the conference is about. If he does that, the market implications might be relatively minimal. On the other hand, he could steer markets in a relatively hawkish direction by emphasizing that the Fed plans to keep rates higher for longer. Now, that's going to be relatively interesting in terms of how it hits the market because, 2 years ago, he was telling us that inflation was going to be over quickly. A year before that, he was telling us interest rates are going to remain very, very low for a very long time. Yeah. And so, there's a bit of a credibility gap. Yeah. And then very lastly, there is a dovish possibility here, and that is that he comes out and says, that we have seen growing evidence of disinflationary forces in the U.S. economy, and that should, negate the need for immediate rate hikes. Like, in other words, he might set the table for a prolonged pause. If he does that, markets could rally pretty substantially on the back of his comments.
I'm trying to think of a structural change we've seen in the U.S. economy. This labor tightness, I don't know, is that a transient thing?
No, I don't think that's super transient. I do think that, your demographic forces are contributing to that. If you look at the structural forces overall globally, right, we have, sort of that demographic issue. We have demand. We have the fact that consumers consumers are aging and they're moving into the phase of their lives where they spend more than they earn. All of that is sort of subtracting from the availability of global capital. It's also, sort of reversing that dynamic that we saw after the global financial crisis, in which demand remained way too low for way too long. And so, I think Fed policymakers, John Williams in particular, think that we are going to see a reversion back to the neutral rate of interest that we saw prior to the pandemic. So they think that, these structural changes are there, but they're not that big. That seems to be the intellectual leadership they're putting out there. But there are, naysayers. There are certainly people, especially in the markets, who think that we have seen a fundamental shift, especially with deglobalization happening, right? This, the fact that we're not able to move people, goods, money, ideas across borders as quickly as we were prior to the pandemic and prior to, perhaps the rise of the populace. All of that impacts the long-term inflation picture, and it impacts where monetary policy settings need to be.
Welcome back. Our next guest says meeting a growing North American helium shortage is a challenge for the entire industry. And at the same time, we're seeing expanding space exploration, as well as increasing semiconductor and chip manufacturing, all of that resulting in surging demand. Let's bring in Andrew Davidson, President and CEO of Royal Helium. Welcome back, Andrew. First, let's talk about this helium processing facility your company is moving forward with. What will it mean for your operations?
Sure. Well, thanks for having me back. It's great to be here. This plant that we're commissioning now is really the culmination of 18 months worth of work, and what it'll do for the company is really transition it out of the exploration stage into becoming a full-sized helium and other industrial gas company. So it's quite transformational for us, and we're very, very pleased with how the process has gone, and exceptionally excited to turn this thing on shortly.
When do you expect to be able to turn it on?
Well, we're going through the commissioning phase now, and that can take anywhere from 3 weeks to a month. So that's roughly when we'll see production start, and then we'll certainly be letting the market know once we've shipped our first load of product out.
How much do you expect to be able to produce there?
Yeah, I mean, it's around 85 MCF of helium per day. The plant itself operates at a capacity of 15 million cubic feet of raw gas. And from there, we separate out the helium through our cryogenic and PSA facility. And we split it into different gas streams, helium, of course, being the most valuable, but other ones that we can capture and monetize are, CO2 and nitrogen. And there's a little bit of methane as well, which we use for power generation, which is a great sort of economic boon to our project. We actually become net power generators as opposed to consumers.
Last time we spoke, you were saying that we were talking about the transparency when it comes to the helium pricing market. And now with this, you're closer to becoming Canada's first public helium producer. Will that help with that transparency?
Oh, absolutely it will. I mean, we, as a public company, obviously we've got obligations to report. And so determining what price we sell at is not going to be a mystery. And that's really the first time in North America anyway where that's the case. And what it'll do is allow for a more clear valuation point for ourselves and for the other helium companies that exist out there. So that level of transparency is something that's been sorely needed in this space since its inception, really. So we think it's going to be a good thing for the entire industry for sure. And as investors trying to make smart investments in the helium space, it's going to make that a whole lot easier.
Wow. All the shortages we've been talking about in the helium space as well, is that helping bring some visibility to this market as well?
Yeah, absolutely. I mean, we sort of saw the first sort of glimpse into the helium industry publicly when Party City ran out of helium for their balloon market a few years ago. But since then, it's grown into far more, serious issues. We had, hospital shorts, so their MRIs can't operate. Things like this, which are far more relevant to, day-to-day investors, day-to-day public. So it's brought a lot more attention to the space, and we've seen that increase in exploration in North America as a result. And things globally, like the onshoring of semiconductor manufacturing and microchip manufacturing into North America, is really spiking demand here even further. And it's really, what we're seeing is more of a secular demand growth versus any sort of cyclical or seasonal supply shortage. And right now, actually, we benefit a bit from both, but I think this secular growth is really going to be the emerging story for helium over the next number of years.
Yeah. Just given the importance of these things, MRIs, microchips, is there work being done to try to find alternatives to helium as well?
Well, as of now, there are no alternatives, but what you're seeing is sort of increased focus on the ability to recycle it, specifically in the MRI sector, which is the largest consumer in North America. And what you see from the likes of Siemens and GE Healthcare is far more helium-efficient products being rolled out. And that's a benefit to everyone, frankly. It's not going to put a big wrinkle into the demand side for producers like us, but it's certainly going to be beneficial for healthcare providers.
Always a pleasure, Andrew. Thanks so much. That was Andrew Davidson, President and CEO of Royal Helium.
Let's get more on this Jackson Hole Symposium and how markets could react to any actual pronouncements on interest rate policy from these central bankers. We're joined by Liz Ann Saunders, Chief Investment Strategist at Charles Schwab. It seems to be a consensus, and I think it's a bit of a tradition at Jackson Hole that they don't say very much germane or they don't reveal very much on interest rate policy.
They don't. But we have to remember last year, even though Powell's speech was quite short, it was also very pointed because that was the time when the market was not just pricing in a pause, which, of course, a year ago, the Fed was nowhere near a pause, but actually a pivot to rate cuts happening in the second half of this year. So no matter what, the speech this year is going to be quite different. For me, what I'm going to be listening for more so than any hints around what they do in September, what they do in November, which seems to be the obsession, is does he push back on the rate cuts that are priced into expectations in 2024? Does he reinforce the for longer part of higher for longer? So that's what I'm going to be sort of keenly attentive to.
So the market's investors are still looking for rate cuts next year, Liz.
They are 4-ish or so, and that's a moving target. That does change. But if you look at history and you look at the span of time between each cycle's final rate hike and then subsequent first cut, there's a lot of variability in terms of the time span. But what there is a decent correlation to is the unemployment rate. Lower unemployment rate tends to, you see a much longer period between final hike and first cut. And given a 3-4 unemployment rate, all else equal, that suggests that there's still more work to be done to price out some of those rate cuts, unless there's more than just cracks that start to appear in the labor market. Still a strong labor market. Now, you're widely followed on Twitter, now called X. Some of the themes that you've been exploring, the narrowness of the market. Obviously, we've heard just a few stocks led the market higher. Give us an update on that, please. It's not quite as extreme. The most extreme in both directions, and I'll explain what I mean by both directions in a second, was right around June 1st. And that was when not only more than all of the performance was accounted for by the mega cap 8 stocks, which weren't just tech stocks. They span into consumer discretionary and communication services as well. But at that same time, only 15% of the S&P's components were outperforming the index itself over the prior 60-day period. That was a record low, at least as far back as we have data. You did see some convergence early on where you saw some profit taking begin up the cap spectrum. You started to see greater participation down the cap spectrum more broadly. Unfortunately, this recent pullback, we've seen breadth pretty much across the board rollover. So we're not quite as concentrated in performance, but there probably is still a little work to do to have the internals of the market look a bit healthier. So just to clarify, recent weakness has shown stocks across the board coming down? Yeah, you've seen breadth deteriorate across the indexes, within the indexes, to a point where I think the relief rally we got a couple of days ago may have been due to technicians saying, okay, we're oversold short term. But I think there's probably still a bit more deterioration to come. Pullbacks, even if they don't turn into corrections, tend to have three phases. You get the initial move down, then you get a relief rally, and then you sort of finish the pullback or correction. I think we may be in that step 3 part of the process.
So what would maybe we'll put up a 5-year chart for the S&P 500. Do you have an actual number where you think the S&P 500 could be headed over the next year?
No, we do not do year-end price targets. Frankly, I think it's a silly exercise. Our investors are all individual investors. Some point estimate on a single day, I don't think provides the right kind of guidance. I guess it's a way for the media to pit strategists against one another, who was right, who was wrong, but that's not what we do. So, I think short term, there's probably more weakness. For any reasonably long time horizon, a year out, generally, I'm going to say I'm optimistic. Chuck Schwab, our chairman, one of the best things he's ever said is investing by its nature is an act of optimism. But that doesn't mean you don't have short-term speed bumps along the way. And I think we're in one of those.
But a year from now, you think there's a decent prospect of stocks being higher from where they are now?
Yeah, but I think there could be interim choppiness. I think what is key to the equity market right now, actually, is for volatility to ease on the Treasury side of things. It's not so much the level of yields that's had a big impact on the market in terms of this week and recent pullback. It's the volatility in that market that tends to be more correlated to how the equity market is behaving. And I think that's an explanation that doesn't get enough attention when trying to look at the anatomy of this recent pullback.
So the U.S. government bond, and your mortgages in America near their highest this century, your 30-year mortgages, and U.S. Treasury bond, I know it's come down from its highs, but it has moved up. Why is that? Why have bond yields come up so much?
So I think it's a confluence of things. Better than expected economic data, ongoing stickiness in inflation, a lot more supply that's come into the market with the Treasury refunding. Concerns about the deficit and net interest costs have led to some selling, which puts upward pressure on yields. And then the transmission mechanism to the equity market is particularly important this year because all of the rally since last October came from PE expansion, no benefit from earnings. So it's all been multiple expansion. And when you see that rise in yields, that means a higher discount rate. All else equal means future earnings are less valuable. And in turn, the more highly valued segments of the market tend to see more downward pressure when you're in that rising yield environment. So that's sort of the why has it happened and how, what's the transmission mechanism into the equity market.
Thanks very much indeed for joining us.